Hey everybody, this is 𝙎𝙊𝙇𝙍 of 𝙂𝙍𝙊𝙎.com. It is Thursday, September 30th, 2021. And back with me is my good friend Daniel Vigario. Many of you know him from our Perth Mint series, where Daniel, as a CFA, had analyzed the 2020 financial statements for the Perth Mint and found, through his analysis, rebuilding the trial balance and doing some extrapolations of the data in the report, that he believed that they were running a fractional reserve gold system and doing quite a few other things. He's going to explain, for those of you who are new to the program and haven't seen that Perth Mint series, what we found in last year's financials. And what we'll spend the bulk of the time talking about today is the 2021 financials, because those have come out recently and Daniel has analyzed those and has some new insights for us on the Perth Mint. Daniel, how are you doing today?
Hi, Rob. Good to see you again. It's great to be with you once again, and the viewers. Thank you.
Yeah, thank you. And first of all, Daniel, thank you for taking the time to join us. And secondly, all of the hours that you put into this. I know rebuilding trial balance sheets is hard work. It takes a long time. It takes a high level of expertise. So, you know, I think the audience definitely appreciates all the time you put into this, because if we hadn't had you looking at this, this probably would have gone unnoticed, and all of the conclusions that we have from it, the public wouldn't know about. And I know that you had expressed a little bit of frustration that it appears as though Perth Mint kind of got away with what they did. But I think the value here is in letting the public know what they did, because eventually, you know, all the things going on in the metal markets coming to light, people are starting to wake up to that fact, and there is going to be a pushback coming. And this will contribute to that. This will contribute to the education. So I just want to say thank you for that. And I think it's tremendously valuable to the gold and silver community.
Appreciate it, Rob. Thank you very much.
You're welcome. So if you'll give us just a couple of minutes on what you saw last year to catch everybody up to date. So this will cover our previous videos in summary form, and then we'll break down what you're finding in the new financials.
Sure, Rob. So let me just share my screen quickly, and I will just quickly high level go through what we went through last couple of series. I'm assuming you can see my screen now.
Yes, we can.
Okay, so at a very high level, we took the 2020 financial statements for the Perth Mint. This is the 2021 accounts we're looking at here. So we took these financials, and we, as you said, I created a trial balance, which is just simply taking the balance sheets, the P&L, stacking it on top of each other so that you can see all the data in one nice, neat column. And then you can analyze it month on month, year on year, which we did over time. So for the viewers that are new to the channel, don't get too frightened when you look at the spreadsheet. But essentially what we're looking at here again is just the balance sheet descriptions, or the balance sheet classifications are sitting over here. And then we've got current assets, which is part of the balance sheet. We then have liabilities down here, also stored with the balance sheet. We have equity, and then beneath here we have the profit and loss, which is the income statement. And then all of that needs to tie to zero, which is down here. So all in accounting terms, debits and credits, all the items on the financial statements need to tie down to zero, and then you know that it's correct in terms of what you constructed in the trial balance.
Okay, so to stop you before you go further, for those of you who don't have an accounting background, essentially what he's doing is he's taking the published financial statements where they write it in long form, paragraph form with data tables, and he's rebuilding what should be their trial balance sheet from that. So he's basically reverse engineering it from the data that's in that published and audited financial report for Perth Mint, as well as the notes. And the notes are very key, because the notes we saw last time, the notes weren't fully explanatory of what's going on, and you're going to show us where some of these notes have changed and provide us even more updated information from what you had last year. Okay, so I'll let you go and tell people, you know, basically what you found from the 2020, and then we'll get into the 2021.
So in summary, we're trying to answer three questions in the last couple of series. So question number one is the Perth Mint running a net short unallocated precious metals program? So what that means is, if I look here at this row, the valuation, this is 2020, this column over here is 2020. So the value of the customer accounts plus the value of the leased metal, so 1.7 plus 4.6, total 6.3. Is that greater than or less than or equal to the value of the precious metal stock in inventory being unallocated precious metals in the vaults. So, which is this number over here being 5.4. So to answer that question, if I just scroll down to the summary, we had 1.7 plus 4.6 is 6.3. In the actual vault for unallocated metal, the Perth Mint had 5.4. So the net short to the tune of almost $1 billion Aussie dollars. That was question one answered. They are definitely running a fractional reserve system. As of June 2020, they were short 1 billion Aussie dollars metal in the vault versus obligations to customers and leased
So as of last year, they had more borrowings than they had metals, to the tune of about, looks like about 17%, because they were leveraged 1.17.
Yeah.
So they had 17% net short, which amounted to 929 million Australian, right?
Correct. Yeah, that's correct. That's question one. Question two was, so that speaks to the fact that the Perth Mint customers, unallocated customers, are exposed to a situation where if everyone wanted their metal delivered to them, so converted from unallocated to allocated and delivered, there would be a short of $1 billion Aussie dollars. That's if the customers plus the lessors, so the bullion banks that had lent the Perth Mint metal, if they all wanted their metal back at the same time, there would have been $1 billion Aussie dollars short. And that speaks to the fact that customers are now exposed to a delivery risk of precious metals, physical precious metals.
So Daniel, to ask another question to clarify one of the points you made in our previous videos, this wasn't always the case with Perth Mint. A few years ago, they hadn't borrowed more than they had, or they weren't net short, and they've only done that within the last couple of years. Is that correct?
So in 2017 over here, you can see the position was positive all the way through from 2017 back to 2013. And after 2017, so 18, 19, and 20, they were growing the significant net short position. So unallocated metal in a vault versus the obligations to customers and metal lessors being put in the banks.
Daniel, may I ask you to increase the size of that just a wee bit so that we can get those numbers nice and big for people to see? Okay, thank you.
So the next question, that's risk one that the customers are facing that they're unaware of. So Perth Mint customers, unallocated customers, are not aware of this risk. We've made that quite clear as of June 2020 that the risk is there and they should be aware of it. The second question is the Perth Mint liquid? In other words, so customers have their currency with the Perth Mint, they've invested it in precious metals. We understand the risk of the short position, but is there a risk that the Perth Mint could go bust? Now, we know the Perth Mint is backed by the Western Australian government. So in theory, they can never go bust because they're backed by the government. However, it's important to know whether the entity that you're dealing with, that you're trusting with your metal, is actually liquid. So what does liquidity mean? It means, is the current assets greater than the current liabilities on any company? And if that number is positive, that means they are liquid. If the number is negative, it means they are illiquid, or they're running in a liquid position on their balance sheet, meaning that they could go bust if cash becomes constrained.
Okay, and you're talking about now not just the metals, but all of their financial accounting, right?
Correct.
Okay.
All the entire balance sheet, current liabilities, current assets. So if we stay with these numbers over here, we had 929, almost $1 billion Aussie dollars net short. Then we look at their cash on balance sheet of 127 million, their current assets of 901 million, so almost $1 billion, and then the current liabilities of 254 million. So the total value of all of their current assets and current liabilities, excluding the short position, is 783 million positive, and the addition of 783 plus the negative 929 million gives you in a liquid position of 146 million. And that liquid position was sitting there in 2020. There it is there, as well as in 2019. There it is there. And prior to that, they never ever had in a liquid position. They were always positive assets. Current assets exceeded current liabilities.
So for their fiscal year 2019 and 2020, they went illiquid, meaning they had more overall liabilities than they had assets.
Current liabilities than their current assets, correct.
Okay.
And then the final question was whether the Perth Mint was in some way involved in the manipulation or suppression of precious metals pricing. And that came through by looking at their receivable on their balance sheet at fair value. The reason why they've got this short position is because the Perth Mint, we'll look at it a bit later, actually sold precious metals to a S&P credit rated counterparty. Richard Hayes mentioned it in one of his videos in his interview. And because they sold that metal, being customer metal, it created the short position, and that materialized on their balance sheet in this value over here, which I'm now adding together because I was able to split it out, but we'll get to that a bit later, of 842 million. So they had a large receivable on their balance sheet of 842 million Aussie dollars, and that created the net short position in precious metals versus customer accounts because they actually sold it. Now, we discussed on the prior shows that this is a genuine receivable payable in the future. It's a metal that's gone, it's left the Perth Mint, it's sitting with an S&P credit rated counterparty, and that suggests that they are involved in some way in the suppression, or at least involved in manipulating in a way the precious metals market somehow, because their counterparty is a very big counterparty. But we will touch on this a bit later because I've got some new evidence on that.
And to bring everybody up to date, if you're new to the series or you've forgotten since we last did one of these, I believe it was the CEO of the company which came out in an interview on Kitco and said that receivable belonged to an S&P rated entity. An S&P rated entity means you're a big entity. It's not a family office. We're talking about like a major global corporate, a metals exchange, somebody along those lines.
Correct. That's correct.
And that's how we made
So
that conclusion.
Where we are today is
that went, to a party like that, and it wasn't a bunch of small. It wasn't a bunch of small transactions. It was probably a big transaction to a big entity, which would have some sort of interest in trading that commodity, and we think maybe bailing out one of the exchanges or being used to facilitate liquidity in the market to suppress the prices of metals. That's kind of how we came to that conclusion. Okay, go ahead, Daniel.
Correct. And then just on the final points on that, we also discussed how that receivable attracted revenue interest, so an interest income to the Perth Mint. They were actually charging interest on that receivable, which supported the fact that that is by definition running a fractional reserve system. You've got metals in the vault, which is lower than your liabilities to your customers and the lessors, which materialized because they sold it to an S&P credit rated counterparty. They earned interest on that receivable, which you proved throughout for 3 or 4 years. And that is how banks work. Banks take customer accounts and they use it and they earn interest on it, and the customers are not aware of this. So they
weren't just a depository. They weren't just a place people could store the precious metals. They became a gold bank.
In a small way, correct. Yeah. Okay. Obviously in a very small way, but that's what happened. And the customer, we're just trying to prove that the customers are not aware of this, and we try to bring it to light.
Okay.
So where we are today is that they have now issued their 2021 June report. Okay, and obviously any comments that I make today, it's purely based on the information in this report and any prior work that we've done and prior comments that were made by Richard Hayes and others. So I'm not using any other information. It's just this report. And what I would say is that what I've seen in this report is the Perth Mint is a microcosm of what's happening in the world. And I'll use that term quite broadly. There's a lot of things going on right now in the world that are hugely worrying and concerning. And it boils down to ethics and doing what's right. That's what it boils down to. And the Perth Mint is a microcosm of how, in my view, based on their financials, that's not happening. What's happening is that the wrong decisions are being made. These are unethical things that are happening. And I think that what's happened in this year has elaborated on that regarding the Perth Mint, which I'll highlight in this presentation. So I want to just start off by reading an extract from Richard Hayes, his report in the set of financials. So if I just go down to page 14, this is Richard Hayes, the CEO of the Perth Mint. I just want to highlight just the first paragraph here. And as I go through this presentation, unpacking what we've discovered, I just want you to bear these words in mind, and we'll come back to this report later. So he says here, our values are at the heart of our organization and drive how we deal with each other, how we make decisions, and with whom we will, and importantly, will not do business. Our focus in 2020-2021 has been on improving our approach to environmental governance matters and introducing sustainability across our businesses, embodied in a single phrase, our desire to do the right thing. Okay.
Okay.
This is Richard Hayes. So I have now taken the financials for the Perth Mint for the year end 2021. I'll just quickly show you what they look like, so I'm not making this up. You just scroll down all the way to the financials, you'll see the audit report is there, and then they're over here. Income statement, balance sheet, that's basically it. And then there's some notes as well towards the back. Right, so I've constructed now the 2021. Now let's readdress these 3 or 4 questions that we highlighted at the beginning of the show. Right, so number 1, is the Perth Mint running a net short unallocated precious metals position, i.e. a fractional reserve system as at June 2021? If I go to the financials, you'll see here the customer accounts have grown from 4.6 billion to 5.1 billion. So more customers have deposited fiat currency with the Perth Mint. And at the same time, the Perth Mint has paid down or redeemed some of their precious metals borrowings from bullion banks. It was previously at 1.7 billion Aussie dollars. It's now down to 724 billion. So they've paid back or redeemed a million Aussie dollars worth of precious, $1 billion Aussie dollars worth of precious metals. So we're looking at the total of that number plus that number versus what they have in the vault, an allocated vault of 5.5. So if I go down to the bottom, just to show you the nice neat analysis, there are those 2 numbers over here being customer account money, 5.1 billion, and the 724 million of interest-bearing borrowings from a bullion bank. Total is 5.9. 5.9 plays 5.5 billion, and they are still net short 328 million Aussie dollars in metal. Okay, so
still short a third of a billion, although they did improve it by about 600 million, correct?
Okay, so how did they do that? All right,
yeah.
They did that by, as I anticipated back on our last show, they liquidated a good portion of the receivable at fair value. That counterparty repaid the receivable, and by doing that, what did they then do? They repaid a good portion of their lessor liability to the bullion banks, and they also used some of their new customer money to repay some of that liability too. So I'm making it very clear. You can see this movement from the 1 billion Aussie dollars of net short from last year to this year, 900 less 326 is about 600. And I'll show you just now that that is almost the entire sale of the receivable at fair value. It was redeemed. In other words, the S&P credit counterparty repaid that receivable, and that cash then was used to pay down the liabilities to the bullion banks, which then reduced this net short position. And I anticipated that's exactly what they would do, and they did that. But technically, they are still net short. Now, the Perth Mint will argue they are not net short because they have another asset on the balance sheet, which we'll discuss a bit later. But technically speaking, metal in the vault, not anywhere else, not on a mine site, not under the ground, in the vault, they're still short 328 million Aussie dollars. So if everyone ran on the Perth Mint, all customers wanted all their metal back, as well as the bullion banks, they would be short 328 in their vaults.
Okay, so you broke up for just a second, so I'm going to restate what you said. You basically said just taking metal in the vaults, they're net short. It's not taking into account any metal that may be coming from the mine, so on and so forth.
Correct.
A receivable, something coming to them. What's in the vault versus what they should have, it's less in the vault than what they should have.
Correct.
Okay.
And it reduced because, as I said, they redeemed the S&P credit rates counterparty paid back 500, almost 550 million Aussie dollars from that receivable from last year that we discussed earlier.
Okay, great.
Right, next question. Is the Perth Mint illiquid? So again, 328 is the short position. You take the cash on balance sheets of 191 million, current assets of 400 million, current liabilities of 239 million. You get a 325 million aggregates of cash and current assets, current liabilities, and 325 plus the negative 328 million actually gets you to a positive 24 million. So now
it's a 352 positive. You said 325. 352 positive. 52. 328 negative gives you a net positive of 24,820
million. 24 million, yeah.
So now they're not illiquid. They actually have more current assets than current liabilities.
That happened because they liquidated the ETF. So you can see the move from a negative 146 million to a positive 24 million is almost the same value as the net position of the ETF. Remember from last year, the ETF, the Perth Mint seeded 106 million Aussie dollars worth of metal into the ETF, if you remember.
Yes.
They got external investment of 345. So 345 less than 514, which is the total value of the metal in the Perth Mint, in the ETF, gives you as a seeding value of 169 million. They sold the ETF in 2021, and by selling it and putting that metal back into stock, it caused this positive liquidity position. So now they're all square.
So they sold the ETF to Goldman Sachs, I believe. And I think, if I recall correctly, the announcement on major financial media was that Goldman Sachs then suspended, in some ways, redemption of the metal through the ETF, so that those who now currently have a position in the ETF may not be able to get their metal that was sold off to Goldman Sachs that Perth Mint no longer owns. But you're saying the sale of that helped to bring the Perth Mint to a liquid position in terms of current assets over current liabilities.
Correct.
Okay.
Okay. Now we need to turn our attention back to this receivable at fair value, because remember, that's what caused the short position last year, and that's what we need to deal with this year. So just to refresh our memories, if I showed you this file from last time we spoke, Rob, you would remember there's only one line that I had here for receivables at fair value. I only had one row, or two now, but I had one, because they didn't disclose last year at a more granular level what this balance was made up of. So if I add these two numbers together, you'll remember it's 842 million. So 293 plus 549 is 842 million, which was the value of the receivable on the balance sheet, if you recall. So if I show you the Word document, which is an extract from the financials of 2020, you'll see this note 10, there's the 842 million receivable at fair value. Now remember that
before you go forward, just to explain what we're looking at, you took in 2020 and 2021, you took note 10, which explained current assets, trade, and other receivables, pasted it into a Word document, and then highlighted things, and you're showing the difference between the two. And the note 10 is as I mentioned at the beginning of the video, for those who are not accountants, note 10 will break down an individual line item on the report and tell you what it is and give you notes as to what they're doing with it, essentially.
Correct.
Okay,
Correct.
keep going.
So if you recall, this 842 million fair value, receivable at fair value, that's what caused the short position, right? Between vaulted metal versus obligations to customers.
Yes.
Right? That's why we have the difference. So quickly reading this note again, remember it said here, this 842 million is receivables and advances to customers at fair value contains amounts owing for metal delivered to and accepted by customers on a deferred settlement terms, i.e. the Perth Mint sold metal, customer metal, unallocated metal, to the value of 842 million to a counterparty, and the counterparty is going to pay for that metal on a very long deferred settlement terms. Okay. Then it says here, within the settlement window, the customer can choose when to fix the metal price. Until this point in time, the receivable or advance is therefore exposed to commodity price risk. And that's why it's valued at fair value, because that receivable moves up and down because there's no spot price assigned to it, because the customer who it was sold to is going to pay at any point in time in the future. There's no defined period.
So they buy it. If the gold price goes down, they have to pay less back, right?
Correct.
So that created price risk to the balance sheet of Perth Mint in a falling gold price environment.
And to the customers of the Perth Mint, because it's their metal that they sold.
Yep.
Yeah, they sold their metal. Right. Whilst the consolidated entity holds the receivables and objected to collect contractual cash flows. In other words, based on this disclosure from last year, we came to the conclusion that that entire 842 million was sold, the valuation of precious metals sold to a third party, an S&P rated, credit rated third counterparty. So there was no other breakdown of the 842 million. We just, based on this disclosure, it was just precious metals sold to a counterparty who is S&P credit rated.
Right.
I'm going to leave this bit over here. It's not important. Then it says that the commodity price risk associated with these receivables is managed as outlined in note 28, which is derivatives. The consolidated entity generally transfers the credit risk to third parties in such arrangements. This is gain derivative contracts to protect themselves against the fluctuation in the receivable, except where the board approves. Then it says that the consolidated entity earns finance revenue through providing these facilities to its customers. So we discussed last time, this is a receivable on the balance sheet. They've sold metal to a SPM credit rated counterparty, and they're charged their counterparty interest on that sale of metal, right? So it's not a broker, it's not consignment stock, it's not anything to do with miners. It's purely selling it to a counterparty and they're charging interest. All right, now watch this. This year, the Auditor General, following our videos, I'm convinced of it because they changed the disclosure note for note 10.
Well, and Daniel, they printed a note from the Auditor General on their website right after you did your analysis and we published it.
Yeah.
Not only that, but they went on 𝙂𝙊𝙇𝙍 and tried to deny, what we're talking about. So we know from the videos that we posted, CEO goes on 𝙂𝙊𝙇𝙍, Auditor General makes a note, Perth Mint makes a note, trying to explain away these things.
Yeah. So the Auditor General has done the right thing here, and they have actually improved this disclosure in note 10, which tells us a lot that we didn't know about 2020, which I'll highlight just now. So this note 2021, here's the 345 million receivable fair value. Remember, this is the same value as those two added together, 345 million, right? So it's the same thing. Receivable fair value, you can see it's obviously decreased. We discussed it already. It's decreased because this counterparty repaid the receivable, so paid the Perth Mint back. The Perth Mint then paid off some of the liabilities to the bullion banks, and that's what then decreased the short position that we just discussed earlier. Right, now watch this. Let's look at the comparison here. So now they say, receivables and advances to customers' fair value contain advances made to mining customers on a delivery of precious metals for refining. Now, Richard Hayes said that in his video, so now we know that these receivables contain advances. In other words, the Perth Mint is sending cash to the miners, so cash decreases off the Perth Mint's balance sheet, and you create a receivable because you're sending money to the miners, and you're sending it to the miners in payment in lieu of metal from the miners for refining. It says your mining customers may contractually entitled to an advance payment in ounces on their metal account after the consolidated entity, being the Perth Mint, has taken physical possession of the underlying precious metals, but prior to the consolidated entity, the Perth Mint, receiving title to that precious metal at the outturn. This is very weird to me. I don't know how
you put that in English?
Okay. So the Perth Mint, which is not uncommon, has paid a miner in advance for the acquisition of precious metal, or the acquisition of the dory bars, right, to refine. So the miners create dory bars, which is an unrefined product. The mints buy those dory bars and refine them, okay? In this instance, the Perth Mint has paid a lump of cash to a miner, and they're going to receive the metal later. So when you do that on the balance sheet of the Perth Mint, you create a receivable because credit cash decreases, and receivable, your asset goes up because you've paid for something in advance. Okay, then the miner then transfers the dory bar to you at some point in the future. And this is where it gets weird. The reason why it's a receivable is because the Perth Mint somehow takes possession of the dory bar, but not title. So if they took title of the dory bar, then it could go into stock. It could be listed on the balance sheet as stock, right? But it's not. It's listed on the balance sheet as receivable because not only has the Perth Mint given cash in advance, but they don't actually have that stock in their vaults. They don't even have the dory bar, on the premises.
This is why last year we noticed the working stock wasn't the working stock.
No,
it didn't go into working stock. It's a receivable.
Exactly.
Yeah.
Correct. Because those dory bars are sitting either in transit or they're sitting on a mining site or wherever they're sitting, but they're not sitting on the Perth Mint premises. Hence why it says here very clearly, prior to the consolidated entity receiving title of the precious metal at the outturn. So it's not stock. But even if it was stock, it's still in dory bar format. It's not in precious metals unallocated vaulted format. So you still got an unallocated short position risk anyway. But let's put that to one side.
Yeah, because if the customer demanded their gold, they say, "Oh, wait a minute, let's get it to a refiner in Switzerland, bring it back down." There's a process.
Correct.
Yeah.
Correct. Then it says here, in these instances, the ounces advanced is recorded as receivable, like I've just stated, because they don't have title, until inventory is recognized at the outturn. Watch this. These advances represented here we go, 329 million in 2021 and 293 million in 2020. So what does that mean? I'll go back to my analysis. I'm now able to split out that 842 million at 2020 into its components. And what are those components? 293 million belongs to advances to miners, and here is your S&P credit rated sale of 549 million. Categorically, now it's undisputed. Whereas before, we knew it was the bulk of it was to this counterparty, but now we know factually that 549 million was the value of the sale of metal to an S&P credit rated counterparty. We know that factually now, okay? Which is really, really interesting because the Auditor General has now come out and done proper disclosure. You with me?
Yeah, and they would not have done proper disclosure if it were not for one Daniel Vigario, because they were going to skate by without disclosing this at all until you did an analysis and hypothesized that it went somewhere in the market. And then Richard Hayes went on with Kitco after you hypothesized it. And we talked about that. And he said it's an S&P counterparty. The reason he said it's an S&P counterparty, he was trying to tell Kitco that don't worry about S&P counterparty, low credit risk. But in divulging it was an S&P counterparty, we said, it's got to be one of the mints or bullion banks or somebody like that.
You helping someone, yeah. Now this is where it gets interesting, right? So now we know categorically what the split is. I don't know what the split is in prior years, but you can see that if you apply the same ratio to the mine, so you kept it about 200, you're getting to about a 300, 400 million Aussie dollar sale of metal to a credit rated counterparty. So this was happening from 18, 19, and 20. So then what happened in 2021? Going back to the note, you can see they've told us here in 2021, the value of the metal of cash to miners is 329. So that leaves 224 million. So you can see here, they redeemed it. And that's what I said earlier on, by redeeming that receivable, in other words, the counterparty repaying the Perth Mint, that enabled the Perth Mint to pay back their lessors, which then created, as we've discussed already, the reduction in the short position. So your next question, I'm sure, is, well, Dan, when did they do that? When did they get that amount redeemed?
Right.
Well, I went and looked at the interest receivable, remember? So now they're charging interest on this. And I can work out, based on the amount of interest revenue, which is 4.3 million, I can backtrack and work out approximately what month that was redeemed. It was approximately redeemed in March, April of 2021. That's when it was redeemed. So now we know the redemption date of this S&P credit rated receivable happened before our interviews, but it did happen in March, April. What happened around that time? We'll have to go back and look at it, but I do know when it happened. It happened then. Okay, so, and if you look, just to close off the loop here, all the remaining disclosure in this new note is exactly the same as this disclosure you had in the prior note. So all they've done for us kindly is just given us that split between S&P credit rated counterparty receivable and miners. Which is really interesting because it tells us exactly what happened. Right, now this is where we go back to Richard Hayes's comments on his exec report. Right, so what does that mean? Like, who won in this whole thing? Okay, well, the Perth Mint is still running a short position. However, they would argue that in 𝙬𝙊𝙍 format, they've got 329 million sitting on their balance sheet as receivable. So therefore, 329 plus the short position of 328, they're actually positive. They would argue it's all fine. There's no short position because we've got this 𝙬𝙊𝙍, receivable sitting out there that's coming back to us. So actually, we're good. We're fine. They are liquid, which we know why, because of the sale of the ETF. So what does that mean? It means this. When you look at their dividends on their financials, you'll notice that their dividends increased from 5.9 million to 23.4 million in 2021. They paid the highest dividend back to the government in 2021. So what does that mean? It means that they put their customers at risk for 3-4 years unknowingly. They then got involved in the ETF and essentially enriched the government. So let's go back to my final point
So they
today.
enrich the government. So let's say if you have a government auditor who may be looking at these financials and there is an interest for the government, perhaps that auditor, decides not to ask too many questions.
Well, it goes further than that. Rob, why do we own precious metals? As an investor, like, why do we hold precious metals?
Mm-hmm.
We hold precious metals because governments are stealing our wealth through the hidden tax of inflation, through fiat currency.
Right.
So now you've got a situation here where the very institution, being the Perth Mint, is quote unquote protecting your wealth via the enablement to own precious metals. But the ultimate benefactor of that is the Western Australian government.
Mm-hmm.
So watch this. So if I go now back to his report, this is what I wanted to say early on, and Australians and others can make up their own minds. Let's just read this last part here from this report. He says here, significantly, as the state's only profit government trading business, we have paid 232 million in dividends and taxes to the state government over the past 10 years. Gold Corporation, which owns the Perth Mint, constantly returns 82.5% of pre-tax profit to the state, to the benefit not just of the people of Western Australia, but indirectly of all Australia. How kind of them. So they put their own customers at risk if there was ever a run on the mint or a stress in the physical market for precious metals. We spoke about that last time. But ultimately, who's in control here? Who's in control?
Mm-hmm.
And if you're going to invest in precious metals for the very purpose of your freedom and your liberty, you're actually putting it in the hands of the Western Australian government. That's what you do.
So conclusion here, when you have a government entity operating a private enterprise, they're not necessarily going to protect the interests of either shareholders or, in this case, the metals holders. They may use that to facilitate their own interest, putting their customers at risk. And that's essentially what we think has happened here with the Perth Mint.
We know it's happened, yeah.
Mm-hmm.
Not we think, we know. We can see it's happened.
Yeah.
And whether these execs have benefited, I know, well, judging by the salaries, it doesn't appear that they have. So I don't know how they've benefited from all of this, because the increase in wages and salaries, they had an increase in headcount. It all ties up. So I'm not so sure. I don't know how these execs have benefited from this entire 3 or 4 year scheme of fractional reserve systems and interest on receivables and all these things, because it doesn't appear that they're being paid anymore. Maybe
it could be on not wages and salaries, but other financial interests, right?
It could be potentially the execs, and I can't prove this because I don't have the information, but these dividends are the dividends disclosed to the shareholder, the owner of the Perth Mint, so owner of Gold Corporation, which is the Western Australian government. But remember that the Gold Corporation owns the subsidiary being the Perth Mint, and there's a potential, don't know, that there could be some dividend distribution to the execs who are the executives of the underlying subsidiary. I don't know, I can't prove it, but I'm just saying this is the biggest dividend haul that the government has ever had from the Perth Mint, going back all these years. You can see it, sorry, you can see it over here. It's the highest they've ever had. So I'm just saying, based on what I've read over here, this sort of ethical desire to do the right thing, and who's actually benefiting from all of this at the expense of customers. It's very clear who's benefited. Okay. And my closing point on this point would be, if I'm a precious metals investor, which I am, I'd want to hold it with counterparties who have no tie whatsoever to any government, is my view. So I'll just stop sharing now, Rob.
Yeah. So what they did, overextended themselves, made some interest income, paid dividends back to the government. The government essentially owns it as a state-owned enterprise in a way. And so the government put all their customers at risk while they were doing the scheme. And in there, they were facilitating a large S&P accredited agency, which used it for something. We don't know what. Was it to provide liquidity to the market, to stabilize some of the derivative markets that come under pressure, or for other reasons? We don't know. That's the piece we don't really know, because once it leaves, the Perth Mint, we don't see the other side necessarily of that accounting, so we don't know. but helping out buddies in some way, making some money along the way, government profits, that appears to be what happened, all putting their customer holdings at risk, essentially, to do this. And so if you hold gold and silver with the Perth Mint, do you now trust them going forward to put your interest first before interests of whoever their S&P counterparty is, their commercial interest, or the interest of the government? And I would say no, definitively not, based upon your analysis of the financial statement. So again, this goes to not only the Perth Mint, but it goes to any depository where you may be storing your metal, especially those ones that are private and we don't have the books and can peer into and figure out, put all the puzzle pieces together and figure out what's going on. There could be a lot of risk here, and you don't know, and you may have no idea whatsoever. So you cannot necessarily just trust that the third party that you're storing metals with is really doing what's best for you.
Yeah. And look, as I said to you privately outside of this video, my heart absolutely breaks for Australians at the moment. I think they're going through a very, very, and also globally, the whole world's going through a very difficult and I'd say very evil time right now. And I don't think Australians particularly care about what we're discussing here, because compared to what they're going through, this is small. However, it's our duty to report on what we see, and we hope we'll make a difference in some people's lives that hold their wealth with institutions that are essentially owned by the government and benefiting the government.
And Daniel, what we're doing basically is just reporting on what we see for the benefit of people to see, the truth. This is just general reporting that is a hallmark of the Western democratic system. Reporting what we see, calling into question things that don't necessarily look completely ethical or on the up and up, especially if there was some jawboning or cover up or whatever the right word is, a lack of disclosure, if you will, lack of transparency into it. And we have to call into question, do the officials of this organization or the government really have the best interests of people at heart? And if you expand that out, it's a hallmark of the American system, certainly. It's a hallmark to always question any sort of authority and say, are they doing what's in the best interest of their customer shareholders or their constituents, in the case, politically? And that's all we're doing. We're just exercising, our freedom of speech to do that. And we are not we don't have any sort of grind or grudge against the Perth Mint. But what we do want people to know is that you have to, trust but verify, if you will. And in some cases, I'd say in this environment, the risks that we have, verify before you trust. And don't necessarily think that the people are always doing what's best for you. And that extends to the whole of the gold market. And at the end of the day, I don't think what we're trying to do is to call into question the integrity of the gold market. What we're trying to do is say that there is risk here. And if you're going to own gold and silver, be careful how you own it. And one more point, watch the flows, follow the money to see who's benefiting from the gold trade. We know they benefit in the derivative markets. It looks like some people have benefited, via the Perth Mint. That's the kind of stuff people should know. This might not be quite as big as the Lehman moment, but it is big for gold investors. It's a big story for them to be aware of, because now the eagle eye needs to go on all these parties, especially the commercial parties and the government parties in the gold and silver trade. We can keep an eye on them to make sure that they're being honest, because at the end of the day, the highest quality asset on the balance sheets of the sovereigns and of individuals ultimately is going to be gold and silver. It's not going to be the fiat system. So we need to, as much as possible, maintain an eye on the metal system to keep that integrity, because the less integrity that metal system has, the less integrity the entire system riding on top of it has. And that house of cards could fall faster. And I think that's kind of the biggest point that I get from all this.
Yeah, I agree. Yes, Rob.
All right. Well, super excellent work, Daniel. Thank you so much for doing that. I appreciate you, doing this for our channel and doing this for the people that support us. And, it's a credit to you for doing this, and thank you. And, this is what we'd like to bring you. We'd like to bring in this kind of research to help you. You're not going to get this everywhere. You're not going to get, a number of guys like us diving down into the financials, but I do think it is of high value, and hopefully, our viewers are benefiting from this.
Thank you, Rob.
Any last thoughts, Daniel, before we sign off?
Just, I think a message to everyone watching the show and others out there, and I've said this to you privately again, Rob, is just get your life right spiritually with your maker Jesus. Make sure that you're getting out of high-priced, overpriced assets and debts and into precious metals. Get water, food, a roof over your head, be mobile, because things are going to get worse before they get better. I can tell you that. That's I guess a positive in terms of get prepared.
Yeah.
Thank you, Rob.
Thank you so much, Daniel. We appreciate it.
Thanks, Ed. Cheers.
Hey guys, if you like this report that Daniel has provided, along with all of the other valuable reports that we have been bringing you, we have set up a way for you to support the channel so that we can continue to do more of this. We have a Patreon account at patreon.com/gold-silver-pros, in which you can support the channel at different tiers. We have 4 different tiers for you, starting at $5 a month, that would allow you to support us no matter what your budget. This would be extremely helpful in us having the time, the money, and basically the capital to do what we do, to do the research we do, like going to the Silver Symposium in Idaho and going out to New Orleans investment conference, which we're going to do here in October, and having the staff and the wherewithal to put together the type of research that you just saw in that video with Daniel. We would not have that if it weren't for your support, and we appreciate all the support that you guys can bring. Note that we're putting tons of content out there on the Patreon channel. You can look at the introductory video, the reason why we're doing Patreon, because I think we're in the quickening of where the financial system is going to get a little bit harder, and we want to provide you more information, but we're providing more frequent postings to you that you can access as a Patreon member. And we will be bringing a lot more. I'm about to do the weekly review that we have every week coming back from the Silver Symposium, and we're putting a ton of content up on Patreon from the Silver Symposium. We talked to a lot of analysts, a lot of company CEOs. We attended a lot of sessions. We'll also be providing some of our recorded sessions from the conference as well to our supporters. So thank you so much for everybody to support us this far. And if you want us to continue to do more of this information to help you have the information that you need to protect your family in these hard times, what are going to be hard times ahead, please support us on Patreon as well as watching our videos on the channel. It really does help. Thank you guys so much. Have a blessed day. And stay tuned further in the week. We're going to have more analysis is coming. We're not going to stop. We're going to keep pushing out that content for you guys to help you make the best financial decisions that you can make. Until next time, this is Rob 𝙂𝙊𝙇𝙀𝙍 with Gold Silver Pros. Hey guys, don't forget to hit that subscribe button and the bell for notifications, and go to goldsilverpros.com and sign up for the free newsletter so you can get your updates.